Good morning, everyone. And here we start with the webinar. And as we all know, the topic of discussion we have is about the impact of inflation and future outlook for key industries. Uh, at the same time, I would like to uh, have a antidote about the things that are happening in the previous past. The way market participants are responding to the burning problem of inflation depends on how well they are able to respond to it or see the big picture. Inflation has been soaring during the past 2 years, and the result has been a spike in production cost and operational spending. Furthermore, leading to product shortages left with little choice. Producers and manufacturers are passing on end cost to the customers who are feeling the pinch on their wallets like never before. And furthermore, the pandemic has eased in the few past months. Besides, in China, it was again back on the back of a post-COVID economic rebound and multiple stimulus packages. Demand has been rising in advanced economies throughout the world. Although we have a lot of challenges to overcome, the supply outlook was looking up fairly in the previous year, but then again, prices shot up and furthermore, with the war creeping in, we've had a lot of issues that have kind of galloped ever since, led by food and energy prices. So to get the basic scoop on the inflation impact, that's why we welcome you to the webinar again. And we have two speakers who are part of our team. Firstly, I'd like to introduce them. George Matthew is part of the market intelligence at Infinity Research. He's an MBA in finance and he has more than 10 years plus of experience on quantitative and qualitative market assessment, growth forecasting, competitor intelligence, category benchmarking, as well as supply analysis and benchmarking. He's a very well uh, sought after webinar speaker and provides a review side of sectors like pharmaceuticals, CPG, and FMCG, energy, and automotive. And our second speaker is Mohana. He's an integral part of the sourcing team at Infinite Research. He holds an MD degree in finance and has more than 5 years of experience in delivering custom market intelligence to decision makers in sourcing and procurement. He has a strong line of projects to his credit, covering industry benchmarking, cost modeling, rate card benchmarking, negotiation advisory, and supply intelligence. His expertise spans various sectors such as pharmaceutical, F&B, industrial and manufacturing, oil and gas, and utilities. And before I pass out to the speakers, I have a general set of instructions for the webinar. Uh, all the attendees will be placed on mute, and in case you face any issue with connections, please try logging again through the link that you received in your email. Uh, and you can just write back to Dennis at infinityresearch.email. In case the problem persists, you can just let us know or just shoot an email to us. And without much further ado, I would like to pass it on to George and he'll take it over from here.
Thank you, Abhishek. Good morning to all the participants and thank you for joining today's webcast. Uh, Abhishek's already given an introduction, but I'll still reiterate. The objective of today's webcast is to discuss the changes that have occurred across some of the key sectors due to the current high inflation situation, and also to see what exactly lies ahead of these sectors over the next few months. We will talk about the reason for the current rise in inflation, how it has impacted the energy, transport and logistics, CPG and FMCG, automotive and ancillaries, semiconductor and ICT, and the real estate and construction sectors. Along with that, we'll also be looking at the expected changes that we can see in these sectors going forward. Just to go back and see, so even before we discuss the impact of inflation on these major sectors, we first need to understand why is it that we are seeing such high inflation across the globe at present. So when the COVID pandemic struck us a couple of years back, economies across the globe took a massive hit. Now, what has happened is that governments in advanced economies were able to pump in significant amounts of money into the economy in the form of various stimulus packages. As a result, these economies were able to recover rather quickly from the economic lows that they hit during the pandemic. But this very economic recovery has, in a way, also resulted in inflation. So the fast and sustained economic revival in these advanced economies actually resulted in higher consumer demand. And that in turn started driving up the prices of products. On the other hand, if we look at the causes of inflationary pressures that are being witnessed by the developing economies, we'll know that it's slightly different. So these economies, even before the pandemic, were actually seeing falling per capita incomes. Now, once the pandemic hit, most of the developing countries had to make do with limited COVID-19 response funds. And since majority of the households in these economies spend a large part of their resources, a large part of their income on food and food-related items, what we observed was that these low-income countries were hit a lot or hit very badly by food price inflations. The global consumer inflation situation had started getting out of hand by December last year. This was mostly due to the high food and energy prices. But the war between Russia and Ukraine has actually like further aggravated the situation. So the war started in February, and ever since the situation has actually kind of gone out of hand. Uh, it can be said that up to 2/5 of the supply issues that we're observing in the global manufacturing sector was actually a result of COVID-induced restrictions such as lockdowns. Again, supply constraints in Europe resulted in the inability of markets to keep up with the strong demand. And that also resulted in inflation in the euro currency area since January of last year. Producer price in the area jumped nearly 10 percentage points compared to the pre-COVID-19 levels. Again, up to 50% of the increase in prices of manufactured goods in the region can actually be attributed to supply shocks, while the rest can be attributed to the increasing demand and spending by consumers. On the other hand, core consumer prices in the region were less impacted by supply constraints, and these actually saw minimal increase as well. However, it's actually the lack of skilled workers and the uh, aging post-war transportation infrastructure in Europe that is actually going to continue straining the supply chains. And we expect the supply disruptions arising from this to last for at least some time into the future, possibly even into 2023. Energy, logistics, packaging, construction, these are all sectors that are expected to witness the most amount of disruption. Now, supply challenges also contribute to inflation in the US, where producer prices increased by around 7%, and core consumer prices increased by around 5% compared to the pre-COVID-19 levels. Also, the labor force participation rate in the country has been declining. And this, along with the surge in container traffic in US ports and the lack of port workers and truck drivers, is actually resulting in higher inflation in the country. I will now let my colleague Mohan discuss how some of these industries have been impacted by inflation and what we can expect over the rest of the year.
Thank you, George. Let us now talk about how different sectors have been impacted by this inflation and the direction in which these sectors are expected to move going forward. While oil prices had fallen significantly during the early part of COVID pandemic, it had started recovering in 2021. However, the Russian-Ukraine conflict has propelled the prices up by more than 50% this year. Demand was projected to return to pre-pandemic levels of around 100 million barrels a day this year, but the war has negatively impacted expectations, with some traders even staying away from new purchases of discounted Russian oil and gas in the fear of sanctions and due to lack of clarity around some spot deals. While WTI crude spot prices traded at $68 20 cents per barrel in 2021. This year started with a high price per barrel of $76 and supplies were tight. By March, however, the prices had shot up to $113 due to a combination of factors, mainly the conflict in Europe, strong demand, and weak supply. The $100 per barrel mark can be considered a tipping point. And when the prices push past this, there is a good reason to worry. The high oil prices mean additional inflation, which quickly start draining disposable incomes of consumers. However, the problem is not only at the consumer's end. Even oil companies are struggling with higher input prices, especially the prices of steel, labor, fracking sand, and ironically fuel. This includes diesel for trucks and natural gas used to dilute semi-solid petroleum. The industry is severely constrained by a shortage of rigs, equipment, and other materials. Even trucking and sand mining activities are affected by labor shortages. There are over 4,000 drilled but uncompleted wells in the US, and companies are reportedly sitting on idle wells on up to 12 million acres of federal land. Although there have been a discussion on making companies pay fees on non-producing wells that have not been used for years together, oil companies are not expected to increase production significantly. Firstly, the capital expenditure on drilling, especially in these inflationary times, could potentially dilute their capital efficiency and mute dividend yields for shareholders. Secondly, factoring in all the prevalent supply and labor shortages, it would easily take oil producers over 18 months to augment production beyond current estimates. In terms of the near future, WTI prices are expected to average around $99 per barrel in the next quarter. The slightly lower price can be attributed to the nearly completed negotiation between the US and Iran to revive a nuclear agreement. Under the deal, the US has agreed to waive sanctions on the purchase of Iranian oil, which could bring in more than a million barrels of oil per day within months of the deal, which is nearly 1% of global supply. Brent crude prices, on the other hand, is expected to remain well above the $100 per barrel mark throughout the rest of the year due to low oil inventories as well as the recent decision of the European Union to ban over two-thirds of Russian oil. Looking at other elements within energy, when it comes to electricity, in 2021, the commercial sector retail electricity prices in the US witnessed the highest growth since 2008. In fact, the prices for most types of energy commodities, including that of power generation fuels, especially natural gas, saw significant increase in 2021, which pushed electricity tariffs to new highs in 2021. The cost of natural gas consumed by US power plant in 2021 averaged at $4.98 per million British thermal unit, which was more than double the 2020 average. In the EU, on the other hand, wholesale gas prices were up nearly 400% in 2021 compared to 2020, while the wholesale electricity prices shot up 260%. The net effect was that retail prices of gas was up by 51%, while that of electricity was up by 30%. While natural gas traded at Euro 47.8 per megawatt hour in the EU in 2021, the geopolitical risk associated with the Ukraine conflict drove prices to Euro 100.7 per megawatt hour in the first quarter of this year. In terms of outlook, we believe the cost of utilities in the US is expected to rise, driven by price increase of electricity and natural gas. The cost of power generation fuels such as residual fuel oil and distillate fuel oil is going to be the primary driver of higher power tariffs. On average, commercial sector retail electricity tariffs are expected to remain high in the next quarter before decreasing slightly towards the end of the year. In the EU, high energy prices are expected to remain a key factor determining the rate of inflation in 2022. And the prices are expected to remain volatile well into 2023 due to shrunken inventory levels and concerns over the supply security of natural gas. The increase in wholesale electricity prices had strong impact on power purchase agreement supply and prices as well. In both North America and Europe, the renewable power purchase agreement was under inflationary pressures toward the end of last year. However, the renewable energy consumption is set to gather momentum due to growing concerns about climate change and the growing demand for cleaner energy sources. Businesses and governments are under increasing pressure from stakeholders to invest in environmental, social, and governance initiatives, ECG initiatives. Also, the higher prices of crude oil and natural gas is making access to renewable energy a necessity. In fact, in the US, the consumption of renewable energy is expected to increase by 10% this year compared to last year. Increased solar and wind generation in the US will increase the share of electricity tapped from renewable sources from 20% last year to 22% this year and further increase to 24% by next year. But more upward pressure is anticipated on power purchase agreement prices as inflation drives commodity prices higher. Looking at the transport and logistics, shipping delays and port congestions peaked in mid-October last year in the US before slowly starting to recover. However, by March this year, the unprecedented supply disruption caused by the pandemic and the demand boom that followed throughout 2021 drove shipping costs sky high. Although the lavish stimulus package in developed economics aided in the fast and strong rebound from the sharp economic decline, it in a way sent transport prices soaring in 2021. This in turn worsened port congestion, the prevailing supply-demand imbalance, and goods shortages. Moreover, the high energy prices also further drove up freight rates. In the first quarter this year, the shipping cost of a 40-foot container jumped 132% compared to the same period last year. These shipping prices were very high, but it typically takes 12 to 18 months before elevated shipping costs start to reflect in prices at retail counters. The rising shipping costs that were noticed through last year is expected to rise inflation by around 1.5 percentage points this year. So the high shipping cost since the beginning of this year can pretty much keep inflation running high and hurt economic growth well into 2023. Moreover, it is still too early to say that the world has completely moved away from the ill effects of the pandemic. COVID lockdowns and restrictions in China up until a few days back were holding up trucking and shipments, adding to global supply chain woes. In terms of outlook, shipping costs are expected to decline from the level seen in the first quarter of this year. Spot rates are also expected to decline due to reduced sales and falling demand on account of strong inflationary pressures and low discretionary spending by retail customers. When we look at the air freight, the demand has been exceeding supply, especially for the shipment of protective equipment. The average revenue per unit has risen considerably since 2019. And this year, the ARPU is expected to be $2.67 per kg, which is well above the pre-COVID levels. After the lifting of various pandemic restrictions and reopening of the economy, the inbound air freight index in the US increased by 21% in 2021 and then went on to a hit record levels in January 2022. Although margins in the air freight segment have been encouraging, it does not necessarily guarantee significant profits for the entire airline sector. Jet fuel price hikes are definitely a factor that needs to be considered. Moreover, the additional fuel and labor required to operate longer routes to avoid flying through Russian and Ukrainian airspace is costing carriers additionally. Looking ahead, Air freight rates are expected to remain higher than pre-COVID levels due to strong demand, particularly from the e-commerce sector and fuel pressures. Coming to road transport. Although the road transport cost had witnessed only modest increase in 2021, the high energy prices and shortage of drivers in Eastern Europe are forcing operators to pass on costs. Input cost of transport equipment components such as semiconductor, aluminum, and steel have also increased, which is expected to lead to upward revision of transport equipment prices. Increased pay for drivers is another factor that would support this move. Along with these factors, there are also other more discrete factors that are putting inflationary pressures on operators. Due to the higher operating costs, road freight rates in Europe are currently running higher than in 2021. In the US as well, the situation is not much better, where due to capacity constraint, truckload rates are slowly increasing. The worst will be if inflation erodes buying power to the extent that end consumers choose to purchase fewer goods. As a cascading effect, the freight industry is going to make less from operations. Also, since retailers will be holding on to large inventories, the freight rates will further weaken. In terms of outlook, the rates are expected to remain high over the rest of the year. The further stages of implementation of the mobility package, which came into effect in the EU states in February and provides mandates on driving times and obligatory rest conditions for drivers, can result in transportation cost increasing by 30% on an average. In the US, intermodal network congestion is expected to slowly ease through the rest of the 2022, with the average length of haul steadily decreasing in the country. The shorter hauling lengths will likely increasing market rates for road freight operators while improving delivery efficiency. Next, we look at the FMCG and CPG industry. With Russia and Ukraine accounting for nearly third of the global wheat and barley supplies, the ongoing war between them has considerably impacted the supply of key inputs and is further worsening the inflation, especially food inflation. The impact can also be felt in case of animal feed supply, since Ukraine accounts for around 15% of global corn supplies. And also in case of fertilizer, Russia accounts for around 13% of global fertilizer exports. Moreover, the surging electricity prices that we were discussing earlier is an additional factor resulting in higher costs for manufacturers. After a fall in input prices in 2020, by July 2021, the producer in price index in the US showed an increase of 9.6% over a 12-month period. Producers are experiencing higher prices for a number of commodities, especially wholesale poultry, farm level milk, wholesale dairy, farm level soya beans, farm level vegetables, mainly farm level wheat and wholesale wheat flour. Naturally, the increased prices of raw materials and agricultural commodities and the rising shipping cost have left no choice to manufacturers but to pass on the cost to end customers. The resultant inflation is leading to a decline in consumption of FMCG and CPG products. However, the recent increase in the interest rate by the Federal Reserve is expected to somewhat offset the impact of inflation on food prices, although the relief is not expected to be significant. Over the next few months, all food prices, including the food at home prices, are expected to increase between 5% and 6% in the US. The most impact will be felt in the areas with a strong dependence on wheat as an input, since farm level wheat and wholesale wheat flour prices are expected to increase by over 40% and 20% respectively this year. In the European Union, on the other hand, cost of food witnessed a 8.64% increase on a YOY basis in April this year. This was almost double the core inflation in the region during the period. However, the food inflation in the region has been on an upward trend since at least July last year, due to high commodity prices and surge in gas and electricity prices. Since gas and electricity prices make up nearly 90% of the total energy cost of processed food industry. Going forward, the high prices of energy, fertilizer and feed are expected to continue putting inflationary pressures on food prices in Europe. I will now let my colleague Josh to discuss the remaining industries we plan to cover today.
Thank you, Mohan. Let us now look at the automotive and ancillary sector. So the global chip shortage was already a major problem being faced by the automotive industry. Tight supplies and production cuts linked to the pandemic, as well as the rising raw material prices in the automotive sector had actually resulted in lead times increasing considerably. In 2021, the lead time was around 14 weeks for the sector. The Russia-Ukraine war has actually further impacted operations of the auto industry, particularly when it comes to the Western Europe region. So it has actually created an auto parts shortage that has forced several automakers such as Volkswagen and BMW to reduce production levels at some of its key European plants. The shortages and high prices of input materials such as metals, semiconductors, cobalt, lithium, and magnesium are severely straining the industry at present. The continued increase in commodity prices and tight supplies of ancillaries can only be offset by price hikes and lower discounts. The constrained availability of even simple components such as wiring harnesses, for which Ukraine is a major supplier, has actually brought operational levels of auto plants considerably down. Price pressures for the automotive industry is also rising from the shortage and higher prices of base metals, metals such as aluminum and nickel. So these are metals basically for which Russia is a key producer. Similarly, Russia is also a major producer of palladium, and the fear of supply disruptions actually resulted in the price for palladium reaching an all-time high in March this year. The efforts of auto manufacturers to replace palladium with platinum uh, resulted in the price of platinum going up as well. Now, the two metals are required to manufacture autocatalytic converters used in vehicles. So obviously a price increase would have a cascading effect on the operational costs and the manufacturing cost of vehicles as well. However, this quarter, the demand for these metals from other sectors such as jewelry, chemical, glass industries have actually declined. And that has helped to some extent offset the supply shortage that is prevailing in the market. And has therefore resulted in lowering the prices a little bit. And obviously it's come down considerably from the highs we had seen a couple of months back. Now, another interesting point to note is the sharp increase in the prices of lithium and cobalt. With major automakers investing in battery plants and supply chains for batteries, the demand for lithium and cobalt has actually increased considerably. In fact, the demand for lithium is expected to increase by up to 20 times by 2030 compared to the levels seen in 2021. There is obviously growing concerns among automakers, especially the ones who have invested heavily in electric vehicles that require lithium for batteries. Moreover, any immediate effort to ramp up extraction and the refinement of lithium may not really bring the necessary results, since lithium mining and refinement projects could actually take several years to complete. Cobalt too is actually becoming expensive, although the increase is not as steep as lithium. While the higher demand for metals for auto batteries is a reason for the price increase, a part of the reason is also the constrained supply from Russia, which is the world's second largest producer of cobalt. As such, there seems to be no slowing down of demand from the electric vehicle sector, which seems to suggest that prices of the two metals will continue to remain high throughout this year. However, downstream users, especially in Europe, are actually reducing their dependence on supplies from Russia because of logistical and payment challenges, as well as sustainability of doing business with companies based in Russia. So once they're able to get alternative solutions, once they're able to move to different sources, and they are also able to develop a different supply chain for these metals, maybe the prices could come down. But that would again, like I mentioned already, take at least a year or two to happen. Moving to the next industry, which is semiconductor and ICT. So globally, 2021 had been a tough year for several industries due to the COVID-induced semiconductor shortage. Although chip fabricators had plans of expanding and accelerating their production to stabilize the supply shortage, we first saw the Russia-Ukraine conflict and then lockdowns in China. Now, these two events actually have resulted in the supply shortage getting worse. There have been increased supply chain risks, which in turn has brought in further inflationary pressures to multiple industries. In fact, the supply shortage of semiconductors is now expected to continue till at least 2024. So that's again 1.5 years from now. So there seems to be no respite to the situation. Russia and Ukraine have significant control over global supplies of palladium and neon. And these two key raw materials are desperately needed by chip manufacturers for the production activities. Now, fabrication plants, which are currently running at almost full capacity, are still falling behind and are still not being able to meet the demand for chips from end user industries. In such a situation, any shortage of raw materials will only reduce the chip output further and will aggravate the demand supply gap even more. The biggest fear right now is that the shortage of neon can actually result in steep hikes in prices as well, similar to what happened in 2015, 2016, when the prices for neon actually shot up by nearly 600% after Russia had invaded the Crimean region of Ukraine. Although major chip makers such as TSMC, Samsung, Intel, all of these companies tend to maintain large reserves of neon, and they might also be able to escape severe negative impact in the short term. If you look at the longer term, there is definitely a need to identify new sources for neon gas as well as ramp up production. However, this is easier said than done because identifying new potential sources for neon as well as ramping up production could take anywhere between 9 months to 2 years. And during this period, most of these end user industries, especially the critical end user industries such as automakers, electric vehicle producers, as well as consumer electronic manufacturers and ICT sectors would be exposed to severe supply chain risks. Again, as discussed earlier, Russia is a major supplier of palladium, and shortage of the metal can have a devastating impact on the ICT sector, since palladium is an important raw material in sensors and memory products. Moreover, it is also a crucial source of C4F6 or hexafluorobutadiene, which is used for advanced node logic device etching as well as in advanced lithography processes used in the chip production process. Looking ahead, we expect the supply chain disruptions of neon, palladium, and C4F6 to definitely put inflationary pressures on the already strained semiconductor industry, and it might take some time before any sort of normalcy uh, can be witnessed. The last sector we will cover today is the real estate and construction sector. The construction industry too is facing a rise in input costs. The cost of purchasing materials, project parts, or even the cost of moving workers to construction sites has been increasing considerably. Moreover, due to the oil and gas price surges, even construction materials that contain petrocarbons are seeing price hikes. The surging gas prices also force some of the ceramic product makers from Spain to cut production by nearly 15% since November 2021. And on top of that, the high prices of aluminum, copper, nickel, titanium, these kind of metals is further hampering the situation. Prices of several construction commodities such as steel, wire, nails, gypsum, asphalt, mechanical system, fixtures, etc. So a lot of these different construction commodities have been seeing steadily increasing prices. And to make matters worse, even lumber prices have actually started increasing since November. So while the prices for a lot of other commodities, construction materials were rising since August 2020, lumber prices were actually declining. So that was kind of providing some sort of relief. But since November 2021, even lumber prices have been increasing. So that's further, further deteriorating the situation in the real estate and construction industry. Also, the restricted ship movements and closing of airspaces in Eastern Europe and Russia has affected the emergency delivery of equipment maintenance services. And also the prices of transformers and other electrical equipments has also been increasing. However, the increasing material costs are not the only problem being faced by the construction sector. The sector continues to be pressured by wage increases as well. This is mostly due to a shortage of trained labor and also an unusually high turnover of truckers. Also, another problem for the construction industry is that the material delivery chains tend to be concentrated mostly in the developing countries, which have a lot of low cost labor. But the over dependence on overseas suppliers and workforce increases supply chain risks. And this was something that we could witness during the cross-border restrictions that were imposed during the lockdowns. In terms of outlook, the annual median wage for construction workers in the US is expected to grow by nearly 4% in 2022, while in the European Union, labor costs will increase by 3 to 4%. Now, looking at the demand side, the commercial construction sector is expected to witness strong demand. However, in case of residential housing, the picture seems to be quite different. At the entry and low income levels, the high inflation is forcing customers to cut back spend. And home buyers in this particular bracket are mostly on a wait and watch mode at present. In the middle to higher income brackets, however, the demand is unlikely to be dampened by the inflationary pressures that we're witnessing right now. Looking ahead, the US mortgage rates is expected to rise and residential housing demand is expected to remain low as well. Prices of new houses are expected to increase by around 8% this year, which is lower than the double-digit increases that were witnessed last year. Also, the government spending on construction can be expected to pick up momentum, but that will also take some time, and we expect that to only begin from around 2024 onwards. So this brings us to the end of today's webinar. You can type in your questions in the chat box and we would either respond to it in a short while or over an email. In the meantime, Mohan, if you could answer some of the pertinent questions given the current economic scenario. So the first question we had was by when can we expect the overall inflation scenario to improve and reach normal levels?
To be honest, at the current stage, this would be a really difficult question to answer. At the end of last year, there was a lot of optimism that inflation was transitionary. But we all know that inflation has turned out to be more persistent than initially expected. We expected that Omicron variant to be bad and bring in additional challenges to supply chains. But no one expected a war to start between Russia and Ukraine. Such sudden changes make it difficult to correctly predict by when normalcy will be restored. However, having said that, considering all that we know now, it seems that global inflation will ease over the rest of this year, but the year will still end at high inflation rate. We can expect some respite in 2023 when the inflation rates can be expected to fall faster. This is because most of the sectors that are driving inflation are temporary in nature and largely driven by the pandemic and the Russian invasion of Ukraine, but it will still take time to correct itself. Also, the energy markets, which we believe a major role to play in declining inflation rates, will become more balanced toward the end of this year.
Thank you for the answer, Mohan. Moving to the next question. Now that the lockdowns in China are easing, what changes can we expect to see?
As an immediate effect, we believe manufacturers will try to clear backlogs of order, which would mean that the Shanghai port is going to enter into an overdrive mode with a serious knock-on effects around the world. We can expect bottlenecks and delays at western ports in the coming weeks. Also, increased demand for ships could potentially affect freight prices, though the extent of this cannot be determined immediately. Apart from this, as manufacturing activities in China resume, demand for metals such as copper, aluminum, and palladium may increase and will result in their prices going up. This could have an impact on automotive sector. However, all expectation must be made with caution because multiple neighborhoods in Shanghai were placed back under lockdown only a day after the restrictions were lifted.
Thank you, Mohan, for the answer. That brings us to the end of the webinar. I would actually hand it over to Abhishek now. Thank you.
Uh, Thank you, George and Mohan. Uh, Indeed, this session was really insightful, and I guess we were able to learn a lot about the current scenario we have. And I would like to thank all our attendees for joining this webinar. We hope that we all of us we got a lot of out of it. And since we covered a lot of information in a short amount of time, if you have any questions about today's sessions, please do write to us. Our email ID is dennis at inforesearch.email. And as a next step, we have been getting queries like if we'll be sharing the webinar recording or not. Yes, we will be sharing that in the coming week. Uh, as a personal email, we'll be sharing that. I guess that answers a lot of queries coming in here. But thank you for all the attendees for the support, and thank you, George and Mohan, for this insightful session. And thank you again for joining us, and have a great day.
Thank you, everyone.
Thank you.